Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Chart Senior Market Strategist. What can I say except wow? And I'm sure many of you are asking, what do I do now? So I'm going to offer some sage advice. It looks like the markets have finally realized, or the realizations of tariffs, and that has tipped over the apple cart. However, there are plenty of companies that will be buffered from tariffs, and I'm going to make a case for two. Has gold reached its all-time high, and has it lost its luster? And is it time to sell? We'll look at gold and see what we think. Plus, all of your questions, and we've got a couple good ones this week, and a correction I want to make from last week to help me out with today's session. As always, my co-host, Mr. X, Thomas. Oh my God, Thomas.
Oh, what a week, huh? What a week.
Yeah, I mean, in the beginning of the week, I was kind of feeling okay. Yesterday, when the sell-off, I felt like I weathered the storm. I actually made a little bit because I had some puts on. But today is pain day, isn't it?
Close to max pain for me. And I'm sure for some of our viewers, and we are going to try and help them navigate what's going on, John. But before we get into that, I just want to give a quick reminder. Guys, if you're watching directly on our website and you want to ask a question, just click Ask a Question at the top right. You'll see it in the orange color. And then if you're watching on YouTube, just go ahead and ask those questions directly in the chat. I'm guessing we're going to get a ton of questions today, so we will try and get to as many of those as possible. All right, John. What can you say except we are close to max fear. In fact, John, I looked at CNN's fear and greed index earlier today, and it was at a 4. John, I don't ever remember seeing a 4, perhaps intraday at some point in my life, but that is very unusual. In fact, I hate to say it, John, these days are kind of reminding me of 2008, 2009 with just bloodbath after bloodbath, and you think it can't get any worse, and it does. Now, John, over the last couple of years, I've been a buy the dip guy. I'm sure many of our viewers have as well. Today, I actually suspended my buy the dip strategy just because I want to see some sort of bottoming action before I jump in. But John, the question for you is, and I'm sure this is a question for our viewers, has the stock market bottomed, or do you need to see something else before you sort of jump in?
Well, I think this really goes back, Thomas, to something we always talk about, and that is in times like this, as a trader or an investor, it's important for us to have a trade plan, and that trade plans help us from making, mistakes. And usually mistakes are made when we get emotional, right? When, like you said today, fear and greed. So, word that professional traders use is called discipline. So I want to give you some 3 points or 3 words of wisdom about discipline. So, the time to think about selling the market is not after the market has already fallen 15 or 16 or 20%. The time to choose a selling point is at the time of entry. In other words, all trades start with a stop. Point 1. Point 2, Buffett tells us to be fearful when everybody's greedy and to be greedy when everybody is fearful. So both of these words imply emotions, and Buffett is not an emotional trader. And he certainly, his success is not based on emotional trading. But what Warren Buffett is telling us is that we need to take advantage of those who trade with emotions. Point 3, I say and I believe that we don't tell the market what to do, right? We don't stand on the middle of a railroad track on a freight train that's coming at us and say, hey, freight train, you're going to stop right here. We listen to what the market is telling us. So as a trader, I think the message is very clear, and I think you just said it, right? We have moved from an uptrend to a downtrend, and the strategy of buying dips is over, and now we have to start thinking about selling rips. But as an investor, we need to take a time out. We need to take a step back and to get proper perspective to all this noise that is going on around us. So let's do this. All right. So here's a monthly chart of the S&P index. And what you can see here is that, yeah, we're down 16% from our all-time highs over there on the right-hand side. But, since the October lows, we're up, we were up 76%. So this is this is normal for markets, right? Markets move higher and then they correct. So this is normal. And if we look at this from the lens of a Fibonacci or Fibonacci retracement, we've only retraced to the 38th percentile. And that's, in strong bull markets, that's usually a level where the market should hold. But is there more pain to come? Well, corrections typically take about 3 months, 3 to 5 months, matter of fact. So could there be more pain to come? Yeah, I think there is more pain to come if this trend is going to continue. But let's say we believe that price has fallen too fast, too far, too fast. That's from the lens of, let's say, a trader. And as an investor, maybe I've been saying, hey, I've been waiting patiently for a buying opportunity to buy into this market. So how do I, John Rowland, assess the market in terms of saying, hey, I'm looking for buying opportunities? Or in other words, where do I feel comfortable that there's value in the market? So let me show you my process. It's a 3-step process. It's pretty easy to learn. So the first thing I do is I want to look at the market through the lens of an algorithm. And what does that mean? Well, I just want to look at the market from a mathematical standpoint. So I will do a lot of Fibonacci extensions and retracements. And hang on, let me do this right for you guys. That's the wrong one. There we go. So let's do a couple of extensions, right? So let's do this one. Let's do one from this breakdown. This little sandwich here, this little sandwich breakdown. And, what is it about this last move? This last move, we just had this nice little bounce here. Okay. So I'm going to start looking for levels where the market clusters, where our Fibonacci lines cluster right there. The second thing I'm going to do is I'm going to go to Bollinger Bands. I love Bollinger Bands because it's a way to look at the market through probability, all right? And so I want to look at dailies, weeklies, and monthlies. So I'm going to draw lines at the Bollinger Band outer bands and around the means. Now, the mean has moved a lot today on this, but you can see where my lines previously were. So that's the daily. Here's the weekly, right? Remember last time we talked about how the band had turned out, and when it turns out that's telling you there's more volatility. And I said to you guys last week, I was like, hey, I think there's no leg to come, and I'm certainly think that there's going to be more volatility. Boy, we really got it this week. But again, I'm going to draw lines where now I'm not worried about the upper band here. I'm just thinking about the mean on this one, about where those are. And then I'm going to look at the monthlies. Okay. And again, this is going to give me this range of probability. Okay. Where do I think there is value in the market? Or where do I think the range of price is going to come to, some level of support? And then, I'm going to draw lines based on where all these clusters of this information is. Now, let me get rid of some of these fibs so we can look at this. And let's go back to our daily. Okay. So, for instance, this was where it was a cluster, right? All right. So now the market's coming to that level, and I've been patiently waiting for that level. So this is where we're going to start using our other technical analysis. And one of the tools that we have in our toolkit is under bar chart templates. We have one that's called right down here, 13 EMA pivots. I created this template for you guys to use this. And what this does, it helps you look at the internals of the market on the day of action. In other words, when I feel the market has come to my zone of action, I'm going to use this information to tell me, hey, do I want to buy this dip? So you can see that today, the lower support level here, and again, let me turn off, you can kind of see it here. There's that support level, 1518 for the S&P. That would have been a buy level. That was right around where we had all of our confluences. So I'm going to wait for the market to come there. Well, it's falling to the third level of support. So maybe what I do now is I say, okay, I'm going to wait for confirmation. I'm going to wait for what? The price to regain the pivot, or the EMA to regain the pivot, or the EMA to turn positive, or the EMA to, price to get above the EMA. If market doesn't, I wait. And you can see today, right? We fell through support. We never got a retracement up, right? So telling us to wait, right? I'm listening to what the market is telling me. So understand this, and these are the points that I want to kind of make, Thomas, is that have a plan, stay disciplined, right? Don't trade with emotions, right? And then, have that proper perspective to risk, perspective to the timeline or time horizon that you are trading in, or where you defined your risk, and have a proper perspective to trend. And if you're buying in a downtrend, well, you better make sure you are buying a market that is bottoming. Now, for me, a lot of times in investing opportunities, I wait for 2 green candles at a weekly time level. A lot of my buy strategies, my breakout strategies, are designed when we see 2 positive candles, and we haven't seen that. So, yeah, I think there's an opportunity to buy today, but the market is telling me, no, you got to wait.
All right. Great advice there, John. So obviously this is a difficult environment to try and find stocks that you want to add to your portfolio, but it appears at least, that we are entering a period of high tariffs. And we've talked in the past, John, about stocks that could perform well during a period of stagflation. So let's just change the verbiage a little bit, John, and try to find those stocks that could do well, or at least maybe outperform the S&P 500, John, if these high tariffs do in fact stay in place.
Yeah, so I just basically changed the name of this watch list from stagflation to tariff resilient. But let's think about what we want to do, right? So market is telling us that there might be a growth problem, so slowing growth, and so a lot of our tech stocks are the ones that are being punished. But how can we avoid tariffs? Well, we can start thinking about American companies that source materials from inside the U.S. and sell their goods and services inside of the U.S. So I'm thinking right off the bat, I'm thinking utilities, right? Duke is a great utility, right? It has nuclear power. It uses a lot of natural gas, right? It's not importing foreign oil, and it's selling its electricity in the Carolinas in a growth area, right? So that is a good story for me. Plus, it pays a nice dividend. But then we're going to talk about, let's say, consumer staples, right? Things that people need to use. In other words, we want to look at companies whose demand for their products and their services are inelastic. In other words, that price probably is not going to have a much effect on them. People got to eat, right? People got to eat. People got to use, toilet paper and Kleenexes and paper towels, and you have to buy insurance and all these things. So I think there's a lot of companies that we can look at. And so here's a list of some of them that I think, not all of them, just some of them. These are the ones I kind of been throwing into this list for a while. Now, we look at what's going on today. Today is a baby in the bathwater day. There's no question about it, right? This is probably one of those statistical anomaly days that you will see in your trading life maybe once every 10 to 15 years, maybe once every 20 years. But you can see, there's only one company that is not down today. That's ConAgra. But let's look at this from the proper perspective. And the perspective is performance, and the performance of these stocks since year to date. And it's a different story, isn't it? Look at all those positive numbers. Now, the ones that are on the, extreme end and the bottom side of energies. Energies got hammered today. But here's the top, let's say, of the ones that we can start thinking about. And you can kind of see those lists. Utilities, right? Consumer staples, insurance companies, telephone companies, right? A lot of dividends companies, right? Some people might say these are more defensive type companies. But, look at Coca-Cola. I think it's up about 14%. Well, now it's 12%. Kimberly-Clark, right? Paper towels and toilet paper and things like that, right? They're still up 6% for the year to date. Tyson's Foods, it's up 4%. So you think about it, these companies have still produced positive results in what I would consider, a tsunami or even a hurricane of a headwind, right?
All right. This is going to be a great tool, John, for us to reference as we continue to go through the upcoming weeks and months ahead, and we'll see how these perform.
Yeah, let's look for this. Hopefully, we'll get this up on the site sometime soon. This list of stocks.
Absolutely. All right. So, John, obviously we're going through some pain in the equity market, but if we jump to the futures, we're obviously going to take a look at gold, which even despite, John, the last couple days, which have been pretty painful for gold holders, gold hit another all-time high on Wednesday. I mean, it has just been an absolute machine. We've talked about it many times before. We were both extremely bullish on gold. But, John, I think it's getting close to a point where people are going to start asking themselves the question, is it maybe time to sell or at least scale out a little bit? John, what do you think we should do?
Yeah, it's kind of funny. Thomas and I were, we in the beginning of the week, we kind of said ideals back and forth to them, and you put out this idea that hey, we just made 3,200. That was a target that a lot of people had put out there, and you're like, is this the top, or how far do we think the market could go? I can't remember exactly how you posted the question to me, but it basically, my rebuttal was where and when, right? So I was like, okay, where do we think the top is, and when do we think the top is going to be occurred? So again, I've gone back in the past here. We looked at it, the GLD. This is the ETF for gold, and I said to Thomas, well, if I just extend my Bollinger Bands, and let's remember this was on Monday, so this is a lot different, and I just extend those Bollinger Bands. In other words, I'm in this channel or this trend, kind of like what we saw here. Where can I expect us to reach? And I gave you guys a level. We've looked at this level for, I don't know, about 6 months now, where I really do feel that GLD was going to get somewhere between 293 and 297. So we're getting close. We were getting close to that. But we also said 3,200 was kind of the number we were looking at. But, I said, all right, well, I said to Thomas, well, I'm going to stick to my guns. I said that the word GLD is going to get between 293 and 295, 297, sometime between now and the end of the year. But in the meantime, right, so, we did get there, right? And then we reached a level of resistance. So what could we say? Well, let me get rid of these two rays so we can get them out of the way. And, what happened? Well, look, we had 4 days now where we had the exact same high. So that's significant to me. That tells me something. And then, again, if we think about it in terms of Bollinger Bands, we were outside the Bollinger Bands briefly and then piercing, and now we've got a mean reversion. So this is kind of a corrective stage in gold. But there's a lot of folks out there, I'm sure, are saying, hey, I've always thought gold was a safe haven, or it's a hedge against inflation. And I've always said to you guys that gold has a much higher positive correlation to the equities market. And so that if you wanted gold to get higher, you need the stock market to go higher. And sure enough, you can see that, today, right, the market went down and gold went down significantly. It was a big day today. So, again, this is a risk asset. And so what the market is kind of telling us is right now is risk off, right? Risk off. And there's profits are being taken in the gold market. Now, My concern would be this level, this new level of 289, but the trend is still in control here. And, yeah, maybe this actually is a buying opportunity right around the mean. Certainly looks like a level where we broke out from the last time we kind of were moving forward. So, I'm not concerned about a trend reversal here, although it did change very quickly. And, we're still above the mean here. So, I think this might be a trading opportunity. But even if the market fell, let's say, to the lower band, I still think that might be a good buying opportunity if we look at this market in, that big picture, that greater perspective uptrend. And I'm sticking to my guns, Thomas. Again, look on the weekly. We are way out. We had been on the outside of the band. So could we get a little bit of a mean reversion on the weekly? Yeah. But would we still be in an uptrend? Yeah. So I'm still sticking to my guns. I still think 293 to 297 for the GLD. I just think that, we have a little bit of a speed bump now in front of us at 289. And what's going on in the broader market, this risk off environment is putting a little bit of pressure on the gold market.
So a lot of people are hurting this week, John. One person who's not is the Oracle of Omaha, Warren Buffett. I posted earlier this week, John. He was just kind of chilling. He's had a couple green days this week, hit an all-time high, Berkshire Hathaway. Now, a lot of people put Mr. Buffett out to pasture, John, saying, oh, this guy's old. He's lost his touch. He just wants cash because he's, getting close to the end. Not so fast, my friends, right? He's doing very well. Now, one of his favorite stocks, John, and we know this because he's always drinking these products. We see him time after time doing this, is Coca-Cola. Now, Coca-Cola just hit an all-time high yesterday. And John, you noticed kind of an interesting pattern formation when you were looking at the charts.
Yeah, it looks to me like this was, up until today, I mean, you talk about, baby in bathwater, but yeah, this is what we call cup and handle, right? There's this kind of this rounding bottom where we come to a level of resistance and the market backs off and then makes another rounding bottom and then comes to that level of resistance. Now, one of the things we've learned in the past on this show is that when we look for breakouts or when we look for market to get above an area of resistance, we need some kind of confirmation. And one of the things I've mentioned to you guys in the past is come under the technical analysis and look at the average true range. This is a measurement of volatility, but it also gives you this kind of this measuring stick. And what the general rule that we're going to use is we want to see the market get 1.5 to 2 times, and this is my rule, 1.5, 2 times the ATR above those levels of resistance. So if we did that, right, so we can see that the ATR has gotten a little bit up inflated today, but, in the last couple of days or last month or so, it's been about 140 to 150. So that would be somewhere around, 210, 220 to, as much as $3. So if we go back to our chart, and this is when we do cup and handle type trades, is wherever we define the resistance, we got to get above there by that ATR extension. And you can kind of see that we got close, but we didn't get there. So this could be a fake out breakout, right? And certainly with the way the market has gone in the last couple of days. But I've also talked to you guys about something called fractalization. In other words, that you will see patterns at higher time frames, and then when you go down to lower time frames, you'll see the same patterns. And that is actually a confirmational thing. So what I noticed today, Thomas, was that this is kind of starting to look like, to me, like this could be a cup and maybe we might make the handle. So this is the cup is really the handle at the daily time frame. This is a 30-minute time frame. Now, ideally, we don't want to see the retracement of the pullback that creates the handle more than 50% from our peak to our trough. So unfortunately in this case, and again, best laid plans of mice and men, we are definitely below 50%. But again, one of the things I said to you is you could use on day of action, you could use that template that 13 EM pilot template and see if you can find some support or structure that is related to that report. And so you can see it's a nice little drop-based rally where the market, this is the last leg up where we burst up. And today we've fallen right to that level of support. So in terms of risk here, I think if we could hold this level and then recapture, let's say, the pivot level, which we see today, and then start making our way back towards those resistance levels, right around 73 and a half, 73 and a quarter, then this will be a great breakout candidate. And certainly, if you think about what we just discussed about, tariff companies or U.S. domestic companies or, do business in the U.S., I mean, next to Warren Buffett, I think you're the biggest consumer of Coca-Cola products too, right?
Well, I'm actually more of a Pepsi guy, John.
I thought you said you were a Diet Coke guy.
I go to the store, John. I kind of look for whichever one is cheaper, but assuming the prices are equal, I'll probably go for the Pepsi. But I'm sort of indifferent.
You're one of those guys who just buys whatever on sale, right?
Yeah, once in a while.
Do you drink RC Cola?
I do not. That one I'm not going to go for.
You're not going to buy that one.
No.
All right. So again, if I go back to this one, this is something I saw in the beginning of the week. This candle again. This might be an anomaly type day, right? So maybe we need to give this stock, the benefit of doubt. Maybe we need to wait a day or two. But certainly, to me, this is a really good example of what a cup and handle pattern looks like.
All right. So, John, my favorite position this week is cash, and I'm sure a lot of people else in the audience also their favorite position is cash. But once in a while, something comes across our radar that looks interesting or appealing. And John, that brings us to everybody's favorite time of the week, which is your pick of the week. What have you got for us today, John?
Yeah, again, on Monday and Tuesday, we'll talk about the difference of, a couple days make, right? So again, one of the domestic companies I was thinking about was Tyson's Foods. And again, Tyson Foods to me, for the last, let's say 3 months or 6 months or so, I really feel that this stock has gotten punished by the bird flu. But the bird flu scenario looks like it's probably relieved itself. Eggs prices have come down. And again, if you look at, people got to eat. And if you look at that protein equation, the cost of protein, the chicken is certainly the cheapest of the three between chicken, pork, and beef. And it's probably the widest it's been in a long time. So I was thinking, this is kind of my thought process that, this would be a good one of those good companies that would be buffeted from tariffs. So again, but let's think about this in terms of my plan, right? I'm buying a company in a downtrending environment, a broader market. So do I want to just buy the stock? No, I don't. So I'm going to enter the market through options. In other words, I'm going to buy calls or I'm going to sell puts as I did. That's going to allow me to limit my risk. So that's exactly what he did. I bought some in the money calls. I bought some June $55 calls. Now I can limit my risk to the value of the calls that I buy. And if I'm right on the breakout on this, if this stock does move up, let's say, I have a couple targets here, $68 and then $75. Well, then I'm just going to exercise those options, and then I will move what I would consider a swing trade into becoming more of an investment trade. So right now I'm kind of in that swing process. I'm using options to limit my risk, but I think the opportunity is still there. Again, if I look at this from the lens of what's going on today, it's difficult to make that case. And we've certainly fallen through the mean after being, outside of the Bollinger Bands, which, what looked like was going to be a mean reversion this morning, now looks like we could fall to the outer band. And so, in terms of risk assessment and starts as my options, well, if I start hanging out below $60 here, probably going to get out of those options. But again, I know what my risk is, right? If I had bought this on the way up as a stock, right, it probably would have been, stopped out of this trade by now.
All right. Great stuff there, John. So I think that wraps up our main talking points for today's show, John. But I know, and I've actually just seen that we have a ton of questions. So you ready to jump into those?
Yeah, let me start off first though. Is last week a couple of viewers called me out on that I had inadvertently said that MicroStrategy would be a good inverse ETF for trading the broader indexes, and what I really meant to say was that MicroStrategy might be a good leveraged ETF to trade against the broader markets because of its high beta. Now, that again, that has been thrown at the door. The stock market fell dramatically this week, and the blue line here represents Bitcoin, and actually Bitcoin is stabilized and actually rallied a little bit. So, it's kind of bucking the trend. But I just wanted to make that correction that a couple folks had pointed that out, and I just want to say I inadvertently said the wrong word. All right, so that's one of our questions. And then the first question is that we got one sent in from a viewer in Australia. And the question, Thomas, was, did you see that question, Thomas, or not?
I did. They were trying to use it's about crude oil, John. They wanted to
Yeah.
try and use the commitment of traders report in order to try and figure out whether crude oil was kind of showing bullish or bearish tendencies.
Right. So if you're not familiar with futures markets, there's something called the commitment of traders report, which basically shows you a report tells you who has what positions, not naming them by name, but by category. So something like a non-commercial or an institutional trader would be like your hedgers, and then money managers would be your speculators. So we get two reports. One's called a legacy report and one is called disaggregated. The legacy kind of looks at the big picture, hedgers versus speculators. And so the question here is, if their open interest is decreasing, right? So the way you kind of read this, above zero means you're long, and below zero you mean short. So if you're moving towards zero, that means you're actually decreasing your position. Usually commercials or hedgers pick tops and bottoms. When their positions get the most extreme, that tells you that you're probably near a bottom or a top. Speculators are the ones who drive trend. So if you were looking at what price action had been doing here, we see it was rising. Now it's falling, but it's falling on falling open interest. So that means that's a weak trend. And you can do this with the disaggregated as well. Again, I would not worry about what swap dealers do. They have their own different world, and other reports are just small traders like ourselves. I would just be looking at producers and money managers. And again, what we can see here is that, they both have a large long position, but the trend makers have been decreasing their long position. So that means you have a weak trend. So whatever price action you saw beforehand, that would be a weak trend. Well, boy, again, what's going on with tariffs, that just upset the whole market. So we'll see what happens over the next couple of weeks. Maybe we'll come back and visit this one in a month and see how these guys adjust their positions. But I do want to point out that commercials are long, and they're telling you that this might be an anomaly, that maybe crude oil prices have gotten too cheap. So let's see if they get even more long next week. Okay. Didn't want to spend a lot of time on that one, but I thought that was a good question.
Yeah, so we've got another question, John. We covered gold today. We didn't really talk about silver. So, this person makes the observation silver just does not want to follow gold. I think that's been the case for a while. Silver has gotten crushed this week, John, absolutely crushed. Why do you think it's in such worse shape than gold?
Well, I think it's more about the fact that silver has a higher beta, right? It's definitely, I think it's a lot more risk type asset. Let's see, May, June. We might be in the July contract. We're still in the May contract. So I just think it's the fact that it's a more leveraged, and it's also because its beta is a lot more, it's a lot more volatile. again, you got to take this with a grain of salt, right? I mean, what we're seeing here is, an anomaly day across the board, right? But this kind of is an idea that this is playing out for an ideal for you, is that you could use silver as kind of an inverse to what you are doing in gold. If you're more of like a steady Eddie gold guy, right? So if you think the gold market has gotten too lofty, well, then you could look to like buy some silver puts or sell some silver mine companies. Or if you want more leverage, or you think the market, the precious metal market is going to go higher, well, then, you could, let's say, buy silver, and then maybe as a hedge, sell the GLD, right? So it's just kind of a way to play that relationship. But I just think that it's more about how highly leveraged is this. And this is a lot more speculative, where it might be more asset management in, let's say, the gold market. Does that make sense, Thomas? I don't know if I explained that correctly.
Yeah, it does. Yeah. My biggest thing with silver has always been it's used in a lot of an industry. So when you have a recession or potential recession lurking around the corner, silver is going to be more vulnerable than gold. So
well, that's a great point too, right? I mean, yeah, awesome. It's used in solar, it's used in computer chips. I mean, it used to be photography, but those days are gone. The old days when I worked on the COMEX exchange, and we're talking about 4 decades ago, it was called the Widowmaker too. So I mean, today I'm sure there's a few traders who drop dread on this drop in price. I don't mean to laugh, but I just remember those days.
John, what if tariffs stay this high or get even worse? How do you play the worst possible outcome that you could imagine?
Well, again, I think you need to start focusing on companies that are going to survive, the tariff onslaught. But, there's no getting around it. We have been in what I would consider a bubble of everything. And so when the bubbles pop, there's really no place to hide. There's becomes a time of deleveraging, and all assets take it on the chin. So the only really safe haven would be treasuries, right? Or um, you know bonds or treasury notes. And you can see that, something we have looked at in the past, the TLT, has now gotten back above the 200-day. But again, what are you going to get out of this, right? How much is the TLT going to run? Long-term bonds going to fall to 3.5%? The TLT is not going to appreciate that much, but certainly it might be a safe haven asset for you to hang out in until, the storm is over, right?
Yeah, and my way to play the worst possible outcome, John, is to maintain dry powder. And that way I can scoop up those bargain basement prices, right? It's everything we dream of, right? I hear people saying, oh, gosh, if I could just go back to COVID and buy stocks, if I could just go back to
Right.
the global financial crisis and buy stocks. Well, okay, this could be an opportunity. Just maintain your dry powder and be able to scoop up those prices. That's how
Wait.
Warren Buffett and Bill Gates and all these guys get super wealthy.
Right. You wait for the market to come to you, right? You're patient and you listen to what the market is telling you. Jesse Livermore used to say, I think in that book, Remnants of the Stock Market, I think he said that there's times to buy and there's times to sell, and then there's times to go fishing. And maybe, like you said, keeping your powder dry, this is the time to go fishing, right?
John, could nat gas be affected by a potential recession?
Yeah, nat gas is very sensitive to recessionary pressures. And again, you're talking about a market that is getting hammered today. And there's a lot of cross currents going on, like, China raised tariffs on natural gas prices. And then that means that there might be more natural LNG going to Europe, right? And so, so that could be, but I still believe there is a fundamental shift away from crude oil as the dominant energy to natural gas. And I don't think that is going to change. And now we're talking long-term, big picture perspective. I've given you guys a kind of this range you need to be aware of. between, let's say, 450 and 380, and you can see we're on the lower end of the range. Maybe the tariffs have shifted that. Maybe we could say 360 on the downside and maybe 425 on the upside, but I still believe the market is going to stay in that range. And then let's see how we get through, we get through all this noise over the next 3 to 6 months.
Just one comment, guys. If you send us questions on specific stocks, especially like small stocks that we have never talked about before, we can't really do analysis on that, but you can go to the website and you can check out the bar chart technical opinion, and that'll give you a sense of where we see things going, at least on a technical level. All right, let's see what we got here, John. Is the market trying to get back to fundamentals, John?
I don't think it's getting back to fundamentals. I think it's getting back to more realistic valuations, right? Again, we looked at, I think a couple of weeks ago, we would say, oh, maybe we like Walmart or we like Costco because those would be consumer staple type companies. But we looked at their valuations and they were carrying valuations that were more similar to, let's say, a tech company, forward PEs of 60 or 40, right? So I just think the market, it's about reassessing valuation. I don't care what metric you use. Up until 6 months ago, every one of those metrics, the CAP index or the Warren Buffett index or, this index or that index, they were all at extreme or historical highs. I just think the market is reevaluating. So I think, fundamentals are going to drive the market, always drive the market in the long run, right? Technicals win the battle from day to day, but fundamentals, win the war, so to speak.
John, do you think central bank buying, global central bank buying could serve as a sort of put protection under the floor of gold, just kind of establishing a floor price for gold just can't fall any further than that?
Yeah, I mean, that's what's been one of the drivers behind gold for the last couple of years, right? This argument that the U.S. dollar is the reserve currency and that money is flowing out of the dollar and is going into other currencies or it's flowing into other assets, and that's safe haven and all those things. Yeah, I think that will continue. That's why I still believe that gold prices are going to go higher before the end of the year. It's just that we're just in a bit of a correction. And again, I think it all comes down to the dollar, the dollar index. You got to watch what the dollar is going to do, because we can talk about fundamentals and drivers and all that kind of stuff, but what is really the driver for gold in all markets is, what is the value of the dollar, right? And so, again, I think we've looked at this. We kind of said, this was kind of our line in the sand, that 104, and now that we're below 104, that is a weakening dollar. And so what could drive the price of gold up? Well, it's if we could get back below 100. I would think that'd be very bullish for gold. But, again, why did gold fall this week? Well, maybe because the dollar rallied this week, right? So, that's kind of where you got to watch gold in that relationship to currencies.
John, you're a big energy guy. Obviously, you talk about it a lot. Have you ever looked at potential hydrogen plays within the energy space?
Yeah, I have, and I've been doing a lot of research, and I'm not going to promise when this is going to come out, but I'm going to have a list. There are a handful of companies that are in this space. Some of them are well-established companies. Other ones are on the cutting edge. I do see a lot of prospects in the hydrogen space. I mean, basically, when you think about hydrocarbons, that's what it comes all down to. So yeah, I think there is, but I think these are kind of like quantum computing, and these at this point is very speculative, and we need to see a lot of research on how we're going to move hydrogen around and how we can convert it. Because remember, Thomas, I don't know if you remember what they filled the Hindenburg up with.
Hydrogen, right?
Yeah, it was. Yeah. It's very highly explosive, very highly explosive. So we got to figure out ways how to contain and maintain. I don't know if I'm going to be driving around a Zeppelin car. You know what I mean?
John, we got a comment. Somebody would like to see you do a webinar to emulate Jesse Livermore's trading methodology.
Oh, that's a good idea. I like that idea. I'm sure, there's a couple books I read every year. And a lot of times when I'm not trading well or I feel like I'm out of sync with the market, that is definitely one of the books that I read. So, a lot of the things I preach to you guys or I show you, or a lot of the stuff that, comes through in my analysis has been influenced by Jesse Livermore, or at least his teachings.
John, do you, I think the answer is obviously yes, because you talk about puts, but do you ever recommend shorting the market, or is your put strategy mainly to serve as only protection?
No, I definitely buy puts on that speculation of market going down. I showed you guys a trade last week in the Las Vegas Sands, which was a bearish trade. So yes, I do. That's exactly how I do it. When we get the market gets to tops and extremes, I will buy put. I'll do like collar trades, right? I'll sell call and then take that money and buy a put as protection if I think the market is a little bit overdone. But certainly in this scenario where we're now in, we'll sell the rips. Anytime the market rips higher, I'm going to start looking to buy puts. So yeah.
All right, we're going to do 2 more questions, guys, and then we'll wrap it up for today. John, first question. Do you think foreign countries could try to drive the value of the dollar down in order to pay for these tariffs in their own currencies?
Yeah, that's way outside of my right. And then you're talking conspiracy theories and stuff like that. I just feel like the dollar is just too involved in world economic activity. I think, what is it, about 50% of all transactions are in the dollar, right, Thomas?
Yeah.
So,
kind of a related question or thing that I saw the other day, John, was that foreign countries could perhaps slow down their buying of U.S. treasuries because of what's going on in terms of the global trade war.
I don't disagree with that. I think that is exactly is probably going to be. You can already hear from some of the central bankers from the EU. It says, well, maybe the way we punish the U.S. is we won't buy U.S. assets. Well, what they're really saying underneath their breath is that we won't buy U.S. treasuries. But that's kind of spiting, cutting your nose off to spite your face. If they want to drive the U.S. dollar down and not buy U.S. assets, right, buy U.S. treasuries, well, the price of treasuries falls, the yield goes up. And when the yield goes up, it attracts capital, and that will raise the value of the dollar. So, I don't know. There's just too many balls in air to try to figure that one out.
All right, so we'll finish off with this question, John, which I kind of like. So question is, if an investor follows Warren Buffett's investment philosophy, their strategy, but does not live as long as Mr. Buffett or Charlie, who have they went on forever, John, would that strategy still work?
I got to think about this one. I mean, the strategy is a very simple strategy, right? He doesn't buy the market; he buys companies, right? He buys companies when he thinks there's value. I mean, it's a different type of strategy, right? What we do on the channel is we try to time the market, or we try to look for value through technical analysis, or we try to identify trends and then develop strategies based on the trends. Buffett's style is totally different, right? He looks at the company and he looks at how much their money flow or the free cash going to flow, and he discounts it. What he thinks is going to happen in the future. He discounts it, and then he figures out, hey, is that discount value where the stock is trading today, or is it traded below that, or is it trading above that? And then he makes his decisions based on that. So it's a totally different trading strategy. All right, let's leave it at that, Thomas.
It depends on how long you live too. I mean, if we're talking like, I hate to say it, but if, you need a long enough span, on a long enough horizon in order for fundamentals to come back into play, right? I mean, we've seen that from the start of COVID, John, until very recently, where it's just a huge bubble in the stock market. And it took a while for the fundamentals and valuations to sort of come back into play. So you do need a long-term horizon in order for this strategy to work.
As an investor, yes, I would agree. Correct. 3 to 5 years is probably the short end of the long end of the curve, right?
Exactly.
Right. I mean, look at some of the folks that bought in the Japanese market 25 years ago and thought they were buying value and right, and it took them 25 years until the market came back to those valuations. So yeah, you need time. But again, what's Buffett's philosophy? It's not about timing. It's about what he values to what this company is worth today versus what he thinks it's going to be worth in the future. And I think his forward timeline is something like 3 to 5 years down the road.
Excellent, John.
All right, buddy. Good job today, boy. I hope everybody survives out there. Make sure you guys, don't get emotional, right? It's not as bad as it seems. Could we be in a unique time, right? It's very difficult in the moment to realize history. We could be in a historical move here, and we have seen these. We're overdue for a major correction or a major sell-off, right? I mean, the great financial crisis, or the dot-com bubble, or you go back in the 1987s. So again, listen to what the market's telling you, right? Don't tell the market what to do. So next time, folks, the best of health to manage your risk and the good of all trading.